Hi, welcome to Wealthion. I'm Maggie Lake, and joining me today to discuss the outlook for precious metals is Craig Hemke, founder and editor at TF Metals Report. Hi, Craig. It's great to have you on.
Maggie, thank you. It's great to make your acquaintance. You guys do great work, and I very much appreciate the opportunity to visit with you.
Yeah, sure thing. And what a day to have you on. We have seen almost all asset classes sell off or at least be embroiled in a huge amount of volatility on the fast moving developments in the Middle East, including gold and silver, which I think surprised many. Why did we see precious metals sell off when they're supposed to be the ultimate safe haven?
Well, there are a number of things going on there, I suppose. I think at the end of the day, I mean, we used to joke on my site that, there's so much high frequency trading, so much algorithmic trading that takes place now, not only in the equity markets, but in the futures markets too.
Mm.
That the joke used to be, you could light off a nuclear bomb in Times Square, and if the dollar rallied on a safe haven bid, the metals would go down. And, any type of, World War III event. And now it's exactly what's been happening this week. Lost in the excitement of late January as the precious metals were rallying to their most recent peak. The dollar index from the 19th to the 27th of January fell about 3.5 points.
Mm.
And so piling on every day were these algos that were buying the futures. And so this week, what has, I guess we should have been able to predict was going to happen was a safe haven bid. But what I didn't see coming was how dramatically that would impact the futures markets, because the dollar's up in 2 days about 2 points.
Mm.
And that'll wipe out the precious metals anytime. And that's exactly what has happened. And one last thing, Maggie, exacerbating this, the open interest, total contract open interest on Comex is that multi-year and almost record lows. In gold, it's some of the lowest we've seen in 7.5 years. In silver, it's the lowest we've seen in 2.5 years. And so when you're missing open interest and market participants, you lose depth, you lose liquidity. And that's why, we continually see these, silvers moving up $4 and $5 at a time and $10 intraday, and gold too.
Mm.
And so all of those things are kind of combining this week, on top of this kind of liquidity concern, just sell everything, throw it all out, baby in the bathwater stuff.
Yeah.
To leave us where we are on Tuesday.
Yeah, I'm going to come back to that point about open interest in a moment, but that your dollar comments are spot on. I mean, if for anyone watching the tape, watching commentary all day long, the dollar's going vertical. Somebody summed it up on Substack. The currency no one wanted is now the only pure global hedge. I think the reason this is again surprising is we're supposed to be debasement is the big narrative everyone's on, right? The end, Barron's had it on the cover, the end of dollar dominance. Why is it algos that chose to pick the dollar as the safe haven trade, or is that humans doing it? And should that make us rethink how we're viewing both that narrative and maybe what constitutes a safe haven?
Well, Maggie, I'd say, both things can be true at the same time. This debasement trade is an ongoing, I don't know if you call it a core principle yet, but it's certainly something that underlies hard assets. Anything that's priced in dollars, as the dollar is becoming less valuable as we try to service the 39 trillion in debt. All these things that are priced in dollars seem to go up, right? Because the dollar is going down. So that's an underlying kind of secular theme. Within that, you have things like what we're seeing this week, which is almost, I think you kind of touched on human nature, right? You got this war, the uncertainty of the war. My big concern is, the Iranian regime on their way out kind of goes scorched earth. And, what does that do to the energy market? And that ripples through everything. And so, there's just kind of a knee-jerk reaction, for people who have been in this a long time to say, I got to get in the dollar.
Yeah.
And the dollar goes up. And so then that ripples down, and as it relates with the algos, we'll just call them that. Anytime there's thin liquidity, you can particularly see it like in the afternoon after hours session, and something happens like an FOMC meeting, a Powell press conference or whatever. These gold, silver futures and the dollar index will move inversely tick for tick. And so it just gives you an idea of how dramatic that influence can be intraday. Well,
Mm,
you see it today. Well, the dollar was up more than a point for a while here on Tuesday, but as soon as it started to ease off, the metal started coming back.
yeah.
So it's largely a function of that in the very short term.
Yeah. Yeah, it's difficult. I mean, this is why we talk about sort of separating noise and signal, right? You do have a lot of influence of that computerized trading that happens now, and we're trying to sort through what looks like a fundamental in terms of price action. So, if we are in this reacting, some correlations still hold true and we're responding to what happened to the dollar. Maybe we've got thin trading liquidity in some areas. uh, do you expect does it feel like this downside has momentum? I think everyone's thinking back to the big shakeout we saw in silver at the end of January, thinking, "Whoa, are we going to look at it? Is this a major retracement we're looking at? Does it feel that way to you based on what we saw today?"
It feels like an extension of the current consolidation.
Hmm.
Um, Starting with gold, it was almost now exactly 2 years ago. I think it was March the 1st of 2024. You could tie it back to a speech by Fed, I call them goons, Fed goon Waller, who was giving a speech that day. It was a Friday. And he alluded to cleaning up the balance sheet so they could do more QE in the future. And gold just took off, broke out on that day to new all-time highs above, if you can believe it, $2,100 just 2 years ago. And on the weekly chart, anyone can see it. It's followed a pretty steady progression ever since of 20% rallies, followed by either 6 week out to maybe 4 month consolidation periods where the market just kind of gets used to it. And again, that's supported by all kinds of things like central bank demand and the rest.
Mm.
But nonetheless, it's a pretty predictable pattern. The most recent burst forward from about a top of 4,400 late last year targeted 5,200, and it sounded crazy to talk about that late last year. But then it happened. Now we're consolidating again. The next target is 6,000, and which sounds crazy, but all of these levels, as you've added on 20%, have sounded crazy at the time. So I think we're just in a consolidation there. Silver, same thing. It got out above 85, which is where it was kind of consolidated between 70 and 85. It got above 85. Now it's back below. The only thing I would add to either of those two statements in talking about price is it's only Tuesday. you know, um,
Well, we should timestamp it. It's not even the close of the session yet because things are changing so rapidly
right,
that we're doing our
right.
best to keep up. But
Right. One of the I've been my side. I've been doing this for 15 years, and we have a couple of I call them TFMR adages in if you're trading the precious metals, which were more about investing long term and getting the long term trend right. That serves you really well. So it's more about that than trading. But if you are trading, two things that always seem universally true. One, you've got to always be ready to sell some when things look the rosiest because sometimes it's just so contradictory to the way these things trade. But you also got to buy some when things look the worst. And you think back to February the 5th and silver's washing out on a evening trade before Shanghai opened down to like 64. Well, that looked pretty bad that day. And then look what happened. The other one is it's not how you begin the week that matters, it's how you end it. Because the longer term charts are where you identify the actual secular trend, the hourly charts and daily charts. If you're a trader, that's of value to you. But the longer term trend is revealed in the weekly and the monthly and the quarterly. So it's not how you begin the week, it's how you end it. And so we've started the week terribly, right? But geez, I mean, markets are going to be open for another 72 hours here.
God help us. God.
Yeah. I mean, who knows what it's going to look like by Friday. So we'll, I'm a little I'm going to temper whether we're truly in this consolidation till we see how we close on Friday.
Yeah, that's fair enough. You did mention, since you're looking at the charts, you did mention, 6,000's an upside target. Is there an area of support where you'd expect people to start to gather who are looking for the dip, who've maybe been waiting for a pullback to get involved? Does it look like a spot that you'd want to see hold before you thought, well, hang on, maybe there's something a little more serious going on here?
Yeah, you've got to watch those levels where we bottomed out in early February. Right? It's like every time gold or even silver for that matter breaks out and goes up and then it falls back and it goes up again, everybody starts screaming double top. Well, okay, that's fine if you're, trying to get followers on X, but it's not truly a double top until you break down. You can't see these things until you have hindsight. But if you
Mm.
want to throw darts, and try to say, I called it, okay, knock yourself out. Um, in these consolidation patterns, what hasn't happened yet is a breakdown below your previous lows. It's like everybody recognizes a bull market is a series of higher highs and higher lows, right? So what you don't want to start making is lower highs and lower lows, and because that would kind of show that you've got a trend change.
Mm.
So we went from we blew all the way up to 55, 5600 and came back down. What I had 45 or 46 in the and before we recovered. Really, the support looked to be around 4700 maybe. 4,800 in the April gold that is currently the front month. I'd watch that level. If they really wash us out another, whatever that would be from here, 7, 8, 10%, and you start making lower lows versus where you bottomed in early February, then that would be a warning flag. If we don't start, and in silver, it'd be like, well, below 70, but particularly if we take out that overnight low I mentioned on February the 5th of, I think it was 63.90 on the March contract. If you start taking those out, okay, then we might be into something that's more significant than just another consolidation.
It's good for people to sort of put that on their dashboard, I think, and watch out for that. Let's go back to your comment about open interest. And I love you bringing this up because I think based on everything we've been talking about, right, we're all diving deeper into this space. There are a lot more people who want to have this as part of their portfolio. We created a real assets community because there is such a demand for more information, and just sort of, having access now to some deeper knowledge of how these markets work. And we'll put a QR code up on the screen for anyone who wants to join that community. So open interest, record lows on Comex. Why is this happening? Walk me through what you're seeing and what's occurring.
Well, that's kind of the $64,000 question that I'm trying to figure out myself. Like I said, I've been doing this for 15 years. I've got a spreadsheet I keep on this MacBook that I'm talking to you through right now that goes back to 2012 with every day's open interest change. So when I see a number, like back on Monday, about whatever it was, I got to pull my notes at 117 or 115,000 in silver. I just start scrolling back through that spreadsheet and I immediately identify that it was July 3rd of 2023 was the last time we were this low.
Mm.
So why? That's the question, right? The all-time highs in open interest were in February of 2020, right before COVID hit. And there were a lot of shenanigans going on. And anyway, we don't need to get into that in terms of banks using it and using the EFP to create a bunch of extra little small profits. But at that point, the open interest in Comex Gold hit 800,000.
Mm.
Okay, we're now at 409.
Mm.
Same time, the open interest in Comex Silver hit 244,000. And we're, like I said, I've got it over my shoulder, but I don't want to reach over and grab it.
That's okay. Yeah, it's all right to ballpark. Yeah.
115, we're less than half. Now, again, the narrative that you read from the mainstream media is, they just see the price and they assume it's some kind of bubble, some kind of speculative bubble. Well, open interest betrays that. We can track the hedge funds that trade within Comex, through the commitment of Treasury reports. We know that that's not true. In gold, they had a position net long of over 300,000 contracts before. As recently as last fall, it was over 200,000 contracts. As of last Tuesday, it was about 90. Okay, so it's not like every hedge fund now has taken a long position. The other part is you see this data. Bank of America puts out a lot of good stuff about family offices and hedge funds and other institutions and how much investment exposure they have to the precious metals, and it's all 1% and 2%.
Mm.
So this bubble narrative is put forth, as an explanation for the price, and it's just not at all accurate. And again, at the end of the day, though, the question is why? Why is there so? Why has open interest been dwindling so much, really, since about September? I don't know. It's not easy to open up an account and start trading in Shanghai.
So do you feel like and this was my my thought in question, is it that the action has all moved east and away from exchanges like the Comex? Has the center of gravity and action for metals just moved elsewhere?
Yeah. Hey, I'm telling you, this, like I said, this is all part of what I'm trying to figure out myself. Now, you go back to early December, the December contracts on Comex are typically the highest volume through the course of the year, and they get the most deliveries as we go through the month of December. The front month, I'm sure a lot of your viewers know this, goes from February to April to June to August, a little bit in October, but December is trading all year long. So when the December contracts went off the board at the end of November, open interest has plummeted because, if you're long Decembers and you don't want to stand for delivery, you sell those. And then maybe you go buy back a half a position in February and average back in or something like that. So open interest always draws way down. Well, you can, in my experience, you could always use that as a guide in a bull market to expect a rally, because if you've washed out all these hedge funds, and they didn't put their positions back on, well, as price rallies, they're going to come back in, they're going to start buying again. The banks are going to issue contracts as they say they hedge, taking the short side. So it's almost like the old stock trader adage, about volume precedes price. You could almost look at it and say open interest precedes price, because you're getting more and more institutions and the like on the long side pushing price up with their buying pressure. So this should be a good sign that open interest is so low, because the door is open for hedge funds, managed money, CTAs alike to come rushing in on the long side and push price higher. That's typically how it works. It worked that way in December, but we're sitting here now at, pretty significant lows and prices drifting lower.
Yeah, you haven't seen it come in the seasonal
Right.
way that you would have before, because it didn't show up in February. We'll see if it shows up next. So in February, U.S. Treasury Secretary Scott Bassett blamed unruly Chinese trading for the wild price swings. What did you make of that comment?
I suppose that, it's like any politician, there's an element of truth to it, right? That's kind of how those guys roll. And yeah, you can watch it every night. You watch and we still do, obviously, the price changes in Shanghai. Shanghai's been kind of cracking down on people that are shorting without the metal in hand. They're trying to do some things to gain some control over the speculators in their markets. But I don't think, there was no doubt. And then again, this might be part of the lack of, driving some of the interest away from Comex, because it certainly seemed in December, January, really all of late last year into January, that Comex pricing was reacting to, on a daily basis, what was going on in Shanghai. And there's this notion that, well, arbitrage should close that. If it's $100 in Shanghai and it's $90 in New York, well, that should be a simple arbitrage. Well, logistically, it's a little more complicated than that. But as Shanghai kept going up, that premium between the two, widened out to about 10% and would stay there. Even when the Comex price got to 120 or whatever it was on the 29th, 28th of January, Shanghai was like 130 or whatever it got to. So it almost seemed like Comex was just being reflective of what was going on there on a daily basis. Maybe it's not quite as extensive now that we are in late February and March, but that's a big part of it. And again, is that a physical driven issue over there? Here's one for you, Maggie. I just saw this morning. We've been watching the vaults, the amount of silver held in the vaults of the Shanghai exchange, fall from about, I think it's whatever it was, 50, trying to get my numbers right. Anyways, fallen by about a third or 2/3. And they've been they put this information out every day as to how many metric tons of silver they have. And then all of a sudden they decided today they're not going to report that anymore.
Ooh.
Yeah. Like, well, wait a second. How come? So anyway,
so is there, and this is a question that's come up again and again, I think, is there, are the physical and paper markets getting out of balance?
Yeah. Well, and again, see, this is all part of what underlies what we've talked about at my website for years, and where we go now in this period of physical drawdown. I mean, I think clearly underlying the gold price is this central bank demand, which you can trace back to about 4 years ago. And we had 3 years in a row of record central bank gold demand. That seems to clearly be underpinning, the derivative derived price that, by trading the contracts in London and New York. And now you wonder if the same isn't being true of silver. You've had 800 million ounce silver supply deficit over the last 4 years, where you're just simply consuming and investing in silver at more than what is coming out of the ground and being recycled. Is that having an impact? And again, we've watched these vaults to be depleted in Shanghai. Even there was a big rush to put silver into the Comex vaults about a year ago. And even those levels are down by about a third. So you just wonder how much metal is there that can be levered into these futures contracts.
Yeah.
And maybe that's a function of the open interest too, Maggie.
Yeah.
If it was always stated that the big banks, the bullion banks that are responsible for the physical delivery in London, that what they're doing is they're hedging their physical position in London by hedging it in New York, shorting. Well, maybe they have less physical in London,
So they're not.
and
They don't need.
therefore they're doing less shorting.
Yeah.
Yeah, and that is reflected then in decreasing open interest.
So we'll get to miners in a second, but what happens in practical terms if paper interest just flat out exceeds physical inventories? I mean, this is sort of financialization of everything, right? And we're talking all the time from a practical matter. A lot of people who are newer to this, who are looking to increase their exposure. We've just had David Morgan was just talking to us about changes for 401s, where you now maybe can own them directly in your 401. Most people are going to go through an ETF as their first entry in, at least in the beginning. What happens if the paper demand just exceeds physical inventories in practical terms?
Well, all right, Maggie, this is where we can really start having some fun, right? This has been my mission for, like I said, for 15 years now. I'd like to see the precious metals trade on just the physical commodity itself. Okay, I know there's got to be some leverage because that's why commodity markets are set up in the first place, right? So that producers could sell forward or hedge their, so they could manage, their bottom line and everything else. And then once those contracts are out in the open, the speculators can play with them. To me, I think there's always been a far greater amount of, let's just call them digital ounces, because everything is digital these days, than there is physical that's backing it. And so as the physical gets consumed, if it's silver, or as it gets bought up and hoarded by central banks, as in gold, you're just kind of stretching the rubber band tighter and tighter on the, the leverage versus that physical. Now, look, every 60 days as a front month goes off the board. We just saw it again with March silver. It was, the silver, the Comex is going to collapse and all that. It's not. Where you need to watch, if you're really interested and believe as I do, that at some point in the future, there's going to be like a run. Then watch things like the ETFs. Watch things like the unallocated account, I call them schemes, that are run by mints and brokers and dealers. You're told you can, if you keep it an unallocated account, an allocated account, you're just kind of pooled, you keep your storage costs down, all this kind of stuff. But if you ever need your metal, sign here and we'll get it to you, within a week. If you come back and they say, we'll get it to you in 90 days, you got a problem.
Yeah.
The ETFs are great. If you want to sit there and use them just for price exposure, knock yourself out. Well, what's frustrating is even, big time investors like Stanley Druckenmiller, or, you name it, that have been in and out of gold, they often buy the GLD or the SLV. Well, they don't own anything. Mm-hmm. They own price exposure. Core principle of mine is the physical precious metal. Get it in your own two hands, hold it at a safe depository that you feel very comfortable with the management and how they run their business. But own the actual metal, because if we ever get into a situation, when we get into a situation that leverage snaps, something like the ETF, how's it going to keep up? The price may reset multiples higher when we have to base it off of physical trading, but how's the ETF going to do that if they don't have the actual metal underneath?
Yeah, exactly.
So
And
these are all big picture things.
but there are questions that we didn't ask as much before when there wasn't
Yeah.
that huge, supply issue. One thing that's come up for people who have taken the advice and have owned physical, or thinking of owning, and maybe at some point selling, as you said, take a little money off the table. Uh, a lot of talk about the spreads really widening out on that. And, you bought it and maybe
Hmm.
paid a $2 difference, and now it's 25, right? Is there, what do we have to understand about that? And, is this just because of the state of the market, or do you have to watch out in terms of who's a reputable broker, get yourself in front of someone who's going to give you the fairest spread out there? How controlled in that, and what's the sort of, consumer advice on that?
Well, there was a lot going on at the end of January when that was, there were stories about that all the time. Here, hey, price is 115, and the guy at the local coin shop won't give me more than 100, that kind of thing.
Mm-hmm.
Look, I'm not a bullion dealer. I mean, that's a kind of sophisticated business that I don't, really know the ins and outs of. But I do know at the end of January, there was a lot of dislocation.
Mm.
The people that were trying to sell, the dealers didn't want to buy it because then they couldn't sell it. The refiners weren't taking it. So now the dealers were stuck with inventory that then they weren't comfortable hedging. I mean, there are all kinds of different things that created this perfect storm of that widespread at your local coin shop. I haven't really heard anything about that in the last 30 days. I would assume, if you were to walk into what's spot today, 83. I would imagine if you went to an online dealer or you went to your local coin shop today, you probably, I don't know what they'd give it, maybe 80. I mean, I don't think the spread's $15 anymore.
Yeah, well, that's good to hear. But always good to make sure that you're working with somebody who's reputable, who's going to give you
Right.
the best price. And again, we have communities and we have places that you can go to get some help with that if you need it. So I can hear your concern about the market, because you're pounding that table on what you're worried about in terms of it. But and this is a sort of such an interesting time to be in this space. So if we go back to some of the dynamics that you had been looking for, has anything changed in your mind? Because again, we're all trying to digest what's happening in the wake of unrest in the Middle East now. We've definitely seen energy taking off, a lot of concerns about inflation. We saw bond yields backing up today because maybe now Fed rate cuts are off the table. Central banks are going to have to think about holding steady or even raising rates to try to address inflation. This is all early and it could change, but are you going to be recalculating anything that you were thinking about in terms of the economic fundamentals that were supporting a bull case for precious metals?
Well, all right. Two things. One, in the short term, you don't know. Again, anytime you crack open the box of war, what it was, Donald Rumsfeld used to talk about the unknown unknowns, right?
Mhm.
How does it? You can kind of war game in this in your head, and you think, okay, what if crude goes to 100? Okay, what does that do to the bond market, and what does that do to forex, and how does that trickle, to equities, and is there, all these different things. So I'm not. It's just too many variables to consider a threat to my overall thesis for this year. With that as a backdrop, if I might just give a shameless plug, the easiest way to find my annual forecast, I write one every December or late December into January, is on my Twitter page, which is at TF Metals. The pinned tweet is a link to my annual forecast. And I think as I wrote it this year, I was thinking about how you've been kind of told what's coming. They've been telling you this now for 12 months. And I don't see where the basis of this has changed. Back in February 3rd of last year, Trump was signing an executive order to create a sovereign wealth fund. And he asked Scott Bassett, they said, hey, Mr. President, where are you going to have the money for this? And he goes, well, Scott's got some ideas on that. And Bassett kind of moved his way up next to the Oval Office, next to the desk, and said, well, we're going to stand this thing up for the American people, and we're going to monetize the asset side of the balance sheet. Okay. they've been telling you that this is what they're going to do. Now, that's just one part of it. The other thing that they've been telling you about, remember when Trump took office, it was all about Doge, and austerity, and they were going to balance the budget, just eliminating waste and fraud, all these things that you've heard quite literally for decades. That went by the wayside by maybe last summer. And the entire message began to change to, we are going to grow our way out of this. We are going to get debt to GDP. We're going to get interest, net interest expense to GDP down to more manageable levels. They're not doing that by cutting the debt or the interest. They're trying to grow their way out. A lot of people on X will refer this to running it hot. Bassett had referred a couple times last year to melding together the operations of Fed and Treasury. Even that day, Maggie, on January the 30th, remember the impetus behind that sell-off was allegedly that Warsh was going to be some kind of hawk. Remember that?
Yep.
As if Warsh had pulled a fast one on Bassett and Trump. I mean, they're clearly going to be on the same page. And so what I think they're going to do, and Warsh will be in there by, May when Powell's done. They are moving toward cutting rates aggressively, regardless of whatever happens, that we're worried about over the last, week. They're going to cut rates aggressively. If the long end, if duration starts to sell off in the Treasury market, they're going to begin to implement a form of yield curve control. That's the melding together of the Fed and the Treasury. In doing so, they'll be trying to run it hot, as they said, to grow our way out of the debt, in producing sharply negative real interest rates and sharply negative, even just negative real interest rates, always very bullish for gold. And so that's my general thesis. I think they're telling you what's coming. I think that's what they're going to try to do, regardless of the geopolitics of it all. And that's why, until something changes, as we began this, if gold starts breaking down through 4,700 and the rest, okay, then maybe I got to take a second and kind of try to reassess. But until that changes, I'm sticking to it. I think gold, the next rally takes it to 6,000, and I don't think we've seen the highs in silver yet either.
I'm assuming when you're talking about Bassett, you think that there's a good possibility that they revalue the gold?
Yeah, and there is. I mean, it would be in their eyes, a deficit neutral way to do it. You carry it at 42.22, 8,113 tons. If you revalue it to $5,000, the Fed would then give you back whatever it would be, $2 trillion. Okay. And you could take that $2 trillion and put it in your sovereign wealth fund or buy your Bitcoin fund or do whatever it is you're going to do with it. And they'd say, well, it's deficit neutral. We didn't actually borrow $2 trillion. We just revalued the gold and the Fed gave us $2 trillion in return. Okay. So that's why they would do that. Now, what we don't know, I mean, I wasn't alive the last time they moved the official gold price around. I don't know what that would mean for price. I mean, if they came out one day and said, we're going to call it 5,000, heavens, what if they called it 10, and got 4 trillion? That doesn't mean that gold is trading at 10,000. It just doesn't. It would just be an accounting gimmick. Now, maybe it would. I don't know. Maybe gold would immediately trend toward, whatever level that they peg it at. We just don't know. It's an intellectual exercise as to how the market would handle it. But I can certainly see, again, they've been discussing this. It's actually written into there's that Bitcoin Reserve Act that's a bill in front of the House and the Senate. It's actually written in there, the process of even changing the U.S. federal code that holds it at 42.22. So it's all there. Now, whether they'll actually do it and what the market impact would be, is an open question. What I am more confident in, though, is what they've told you they wanted. And even Warsh has mentioned, what did he call it? Fed-Treasury Accord, I think was the term he used that was picked up by Bloomberg. I'm pretty confident that that's the direction they're headed in terms of fiscal and monetary policy once Powell's gone and Warsh is in. And that is a scenario that's extremely bullish, not only for precious metals, for all dollar-based assets, all commodities, which is what's great timing about your efforts with your business.
And so would you include copper in that? And what about miners? Sure. Let's end on that, other opportunities, because, you're just talking about, we've been talking all show about the supply problem. Would those areas also participate or maybe catch up? Is that where the better opportunity is?
Oh, I don't know if better. I started buying a couple of copper miners last month. Copper's what, $6 a pound. These are all-time highs. And again, boy, that you're listening to people like Robert Friedland or something, and man, the amount of or just the fundamentals, I guess I should say, for copper are just extraordinary. You throw into that fact, this whole critical mineral stuff that the Trump administration has been talking about, and how silver's listed as one of those now. I mean, all of these things are really long-term bullish factors. The short-term trading aspect, and the people that want to, talk about, silver is now going to go back to 40 or something like that. I don't know. But man, the long-term fundamentals for really every dollar-based asset is pretty strong if the dollar is being devalued. And ultimately, Maggie, that's what gold is. I mean, the mistake that I see people make, again, remember when we were talking earlier about just the herd mentality of rushing into the dollar as a safe haven? Mm-hmm. And how people have just always looked at it. And so therefore, that's what we're going to do now, because that's what we've always done. Everybody looks at the dollar as the measuring stick, and as if the dollar is the stable unit. It's not. They've got it 180 degrees opposite with the dollar-based assets, but specifically with gold. Gold is the stable unit. When the Wall Street Journal calls it a pet rock that just sits and collects dust, they're not wrong. It is. It's just a piece of metal. What's changing is not the hedonic adjustment of how efficient gold has become, and so therefore it makes it more valuable. What's changing is the amount of dollars it takes to buy that same ounce year over year. I mean, 10 years ago it was $1,200. 5 years ago it was $2,000. Now it's $5,000. The gold is the same. The ounce, that you have buried in your backyard, it hasn't changed. What's changing is the devaluation of the currency that's used to buy it. And so I'm tying this back into what you said about this debasement trade and all commodities. That's what makes them all, copper, you name it, go up in the price, the dollar price, how many dollars per ounce, how many dollars per bushel, how many dollars per barrel. When the dollars are being devalued, that's the denominator, then the price changes.
And why it's so very important to keep that longer horizon framework in mind.
For sure.
Yeah.
For sure.
Craig, such a pleasure to catch up with you. There's so much happening in the market, so it was great to be able to have a really timely conversation. So thank you so much.
Well, thank you, Maggie. Yeah, if anything, if you're a trader, yeah, you got to stay nimble in times like this, but let's try to keep our eyes on the prize here on the long term.
Absolutely.
And it's been fun to discuss that with you. Thank you.
Thank you so much. You got to stay nimble and you got to stay educated. So if you are not already a part of our Real Assets community, you can click the link and go ahead and do that. Thanks, Craig. Thanks, everybody. We'll see you again soon.